This is Andrew Stotz. I want to welcome you to the Valuation Master Class Show. In fact, the next Valuation Master Class boot camp starts in February. Hope to see you there. Oh, I got an interesting show for you today. And the first thing is I'm going to just walk you through the main things I want you to get from this. The first thing is I want you to see my against consensus view of U.S. interest rates. Second, I want you to get a picture of interest rates around the world. And then the good news is you can get all of this in my global interest rate chart book. Now, before I get started, some of you have emailed me for the chart book, and I've been a little bit slow to send the latest to you because I keep improving it. The global interest rate chart book is 160 pages of charts and summaries, and I've been building this over the last couple of years, and I'm kind of slowly getting it back in, given I've just got so much work going on. So the latest one that I'm presenting today, all you have to do is just send me an email at me@andrewstotz.com, and I'll send you this presentation. And then by the time I get to next week and we have our Monday interest rate show, I'll have the whole chart book ready. And then you can subscribe and join that so that you always are up on global interest rates. And why is it so important? It's important because interest rates determine everything. You know, in valuation, we have interest rates. The discount rate, you know, is an interest rate. The rate that you're earning on equity, ROE, that's an interest rate. Every single interest rate, a deposit rate of the bank, is affected by what's happening with the global government bond rate. So let's do a little walkthrough. The first thing, which is my against consensus view. So let's look at that. So this is what the global interest rate chart book looks like, and this is for November, what we're talking about. Now, you thought U.S. rates returned to normal, but they're about to fall again. That's my statement. And we already saw that interest rates went as low in 2019 for long-term U.S. government bond rates. They went down all the way down to about 1%. And now they are at about 4%. So what am I thinking? Well, consensus sees Fed funds at about 3% by November 2026, but I expect it's going to be closer to 1%. This is very different than consensus. Now, just keep in mind that interest rate on the debt for the U.S. government now equals about 14% of federal spending. And the government, I just estimated that the government's paying about 2.6%, an average rate on the debt. And we know that's rising. And that means that the government last paid almost $1 trillion in interest spending, which is the same as defense and Medicare, and also just, you know, higher than Medicaid. So let's talk about this for just a moment. My expectation is that the Fed is going to reduce rates dramatically. We're going to see that in the next 3 to 6 months. So why is that? And why isn't the market expecting that? Well, the answer to that question is pretty simple. It's called election. In November of 2026, there's going to be a midterm election. If Trump doesn't show good performance, he's going to lose the control of the House of Representatives. The election for the House of Representatives happens every 2 years, and it's notoriously lost every year, every time that there's midterms. The incumbent president almost always loses seats in the House. That's because politicians just generally promise a lot and they underdeliver. And so people are less enthusiastic in the midterms. So my prediction is that Trump is going to get interest rates down from about 3% to about 1% by the time we get to the election. So let's just look at that in chart form again. You can see my estimate is that Trump's going to get interest rates down by June from 3 right now at about 3.7 down to about 2%, and then in October to 1%. That is a major, major move. And if I'm right, the question is, what's going to happen with the US market? Well, it's going to be positive for the US market. The US market could fly. Maybe this would be the last time that the US market flies before we can say, okay, now the US market is overvalued. Now, I'm not saying that I think that this is what Trump should do. What I'm saying is that I think he's going to do it. Remember, that's the important job of an analyst. The job of an analyst is not to try to predict the outcome that you want. The job of an analyst is to pick the outcome that is most likely. And when we think about the most likely outcome, the key thing that we want to think about is, how do we invest on that? How do we benefit from that? And that's the job of an analyst. Now, let's talk about that for just a moment before we go into interest rates in a little bit more detail. So when we look at interest rates falling, it's generally good for stock markets. So the question is, where is it good for? Well, should you buy US stocks? Well, I would argue that US stocks should do very well, I think. And that's why you have to be careful not having a zero weighting in the US. But where I think it gets interesting is emerging markets, because interest rates are high, not only in emerging markets, but developed markets around the world. Interest rates are high compared to the US. Now, that means that if the US rates go down and emerging market rates are correlated with that, which generally they are, you could see a large reduction in rates in emerging markets. And the result of that is you could see those very volatile markets rise even more than the US. Now, we have to be careful that not to be overly optimistic on that, because the problem that the emerging markets have, and almost every country except for the top countries in the world, the developed markets, the emerging markets have a problem in that they can't just print, currency and, spend and borrow, because they operate in the free market. And in the free market, if you spend a lot or you borrow a lot as a government, what's going to happen is your currency is going to depreciate. The market is going to punish you for that because they feel like the risk is rising. The benefit of the US having control of the monetary system and being the leader, and also to some extent the benefit of the euro, is that you can cut rates down to almost zero, as we saw, and the long-term rates went down to about 1%. And your currency doesn't absolutely collapse because there's inherent demand in the currency. So this is, something to understand. So Lee says, I agree with your thought process for lower rates. The wall of US debt that is coming up for maturity is a major factor for me. Yes, exactly. So let's look at that again. Let's remind ourselves of that wall of debt. So what we can see is that right now the federal government is spending about $1 trillion on interest. In the bottom right-hand corner, you can see what I say about that. So about $1 trillion on interest. Imagine if they could cut interest rates down in half. You could cut that in half. And if you cut that in half, that means you can either have more money to pay off the debt, which of course US government's never going to do because they don't have to and they don't want to. So you could have that where the US government pays down some of the debt, possible, but more likely US politicians will say, oh, we can spend more money. And so they'll spend more money on military and all the other stuff. Now, there's a reason why it's unlikely that we're going to see that interest rates are going to go from 2.6, as I've estimated here on average, down from there. And here's the problem that there is with that. The problem with that is when we calculate the average interest rate for US government, we have to think about the term and the term to maturity of those, the average maturity, let's say, of that portfolio. And the problem is that a lot of borrowing has come in at a higher and higher rate, and it's going out. The lower rate borrowing is going out. And so what you have is some momentum for rising rates. If the Fed can get interest rates down very low, then they're immediately going to refinance everything that they can do at the shortest term, right? Let's say 3 month as an example. And if they then refinance at 3 month, they can get that really cheap rate. But how much can they refinance at 3 months? And also, what if rates start to rise again? They're kind of stuck. Now, the question is, can a reduction in these rates bring down long-term rates? Because remember, the government has the ability to affect the short-term rates through the Fed funds rate, but they don't have as much control over the long-term rates. In theory, if the Fed brings down interest rates down to 1 or 2%, a very low rate, in theory, that should bring down the long-term rate from, let's say, 4% or so down to, 3, maybe. Long-term is much less sensitive to the short-term rates by the Fed. But the problem is that there's investors that would say, wait a minute, if short-term rates are going down to 1% as an example, that's going to fire up inflation. And so it's also going to fire up the economy. The economy is going to do better. And therefore, I need to be compensated through the long-term rate, because the long-term rate is a combination of growth and inflation. And if both of those expectations are rising, it may be very unlikely that the Fed or that the US government can bring its cost of long-term and the cost of long-term borrowing in the overall economy down. So this is a debate, but I would argue that if the Fed brings down interest rates, significantly, which I expect that they're going to do, then we're going to see markets could fly. Now, the next question is, how is Trump going to do that? Because Powell gets out of the position in about mid-year of this year, and that's too late, right? I think it's May, and it's too late because you got to get a new guy in there, you got to get the pressure going, and then you got to get the rates down. And the rates have to come down early enough that it's going to have an impact on the economy and the market before the election in November. And that's the reason why I'm saying, basically, he's got to come down by, let's say, May, down to like 2% in order for it to have an impact, from 3.7 down to about 2%, in order for it to have an impact on the election. And so the result of that is that he's got to get his man in there as fast as possible. And this is why I think you can also argue that there's a lot of pressure to get Powell out before the end of his term. Now, Powell doesn't seem to want to do that, of course. Why would he? There's no point. But I suspect that that's the pressure that's going on right now. And then the person getting in is going to cut the rates. Now, you may say, Andrew, this is interference, political interference in interest rate. Oh, come on. Don't be serious, right? The whole U.S. capitalist concept is built upon price controls of U.S. interest rates. So already we know politicians ultimately control interest rates in the U.S. It's not a free market in interest rates. And so as a result, they're always controlling interest rates. That's different from around the world. Take Thailand as an example. We have a free market in interest rates because if the government were to issue a lot of debt or do a lot of spending, what would happen is the Thai baht would completely collapse, and then people would lose confidence, and then it would be over. And so ultimately, the U.S. has a lot of power in relation to the currency. Now, you may say, well, Andrew, Republicans are doing this. Democrats wouldn't do this. Oh, no, you're wrong there too. They're both equally bad and manipulative of the financial system for their own benefit. How did Biden do it? When Biden came up to his midterm, if you recall, what he did was he went into the Strategic Petroleum Reserve that America has with a huge volume of oil that is sitting there in reserve, and he released it. And he released it soon enough, early enough, that it was able to come into the market, depress oil prices significantly, which then depressed, because oil, the cost of oil goes into everything. And that reduced inflation enough so that by the time that we got to that midterm election of Biden, the cost of petrol and the cost of gas at the gas station was down dramatically. And some have, looked at that, as I looked at it that at the time, is that, wow, that was a major political manipulation of oil price to get inflation down so that they could get the votes. And Biden did pretty well in those midterms. So it's not unprecedented. So let's continue on, because I have some other things to go through to talk about. And I talked last week about global markets and said that there's global easing, but higher emerging market yields continue to show high inflation and risk. And let's review what we looked at. So when we looked at both global and developed and emerging, we saw that global rates, 3-month rates, were at 4.3, developed was at 2.9, and emerging was at 6.3. So that means emerging was at a 3.3 percentage point premium. Now, that's not the highest premium it's been at, but it's a pretty significant premium. And that's what I'm saying, that one way to play it, if I'm right about interest rates coming down, is to play it through a portion of your equity exposure through emerging markets. Now, if we look at 1 year, I've just switched this to 1 year, and for 1 year, we can see the yield for 1 year was 4.3 globally, and then developed was 2.9, and emerging was 6.5. That's a 3.6% premium. Finally, let's look at 10-year. And here we can see 10-year yield at 5%. That's about 3.5% in developed markets and 7.2% in emerging markets. Again, a pretty large premium between them. This gives a picture of what's happening globally with interest rates. So what are we seeing globally? Short-term rates fell to about 4% globally, while long-term rates held near 5%. And developed market short-term rates dropped more, now around 3%. And emerging market rates stayed higher, near 6 to 7. And the premium of emerging markets and developed markets stayed wide at 3 to 4 percentage points across almost all maturities. And yield curves were mostly flat, with emerging markets showing a small rise at longer terms. So the conclusion, the bottom line is, global easing but elevated emerging market yields reflect ongoing inflation in those emerging markets and risks. So now, today, I'm going to present the next phase of this. And as I said, I've been, the file that I use is just, it's enormous. And I have about 75 charts, at least, maybe more, in that file. So working with that file is just, incredibly laborious, right? And so, yeah, it takes me a little bit of time, but I got the latest updated today. Roman says, and good morning, Roman. Do you think that saving rates in countries are linked to interest rate levels? I remember when I studied in Germany, that the country has the highest saving rates in Europe. So the question is, do you think that saving rates are linked to interest rate levels? The answer is theoretically yes. When the Fed lowers rates, or the central bank of a country lowers rates, then in theory, all other rates in the economy fall. But this is the problem, and this is the reason why, after the 2008 crisis, the Fed decided to flood the US, the world basically, with US dollars. And that's because, and this is the reason why they did QE also, because what happened was the banks didn't respond. And basically, the connection between Fed fund rates and US bank rates broke apart. Now, part of the reason why they broke apart was because no matter how much the Fed kept lowering rates, the banks were like, look, we're not going to lower our rates on our loans and other stuff. And so, therefore, they basically held their rates relatively high. So the connection between the Fed funds rate and the bank lending rate didn't work. It broke down. And remember that the creation of money by central bank is through the balance sheet of the banks. If the Fed lowers interest rates, their hope is that the banks will lower interest rates and lend more. And when banks lend, that's the creation of money. And what happened was that didn't happen. And so the Fed had to figure out another way to stimulate the economy if they, if the banks weren't lending. And this is, an interesting situation that they were faced with. And so one of the things they said is basically that we'll buy any bonds that you have on your portfolios, that the banks had on their portfolios, and therefore you're going to get more cash. And when we buy mortgage bonds and government bonds from the banks, banks are going to get cash and they're going to lend it out. Well, what happened? The banks got cash and they didn't lend it out. They sat on a high level of cash. Now, this goes back to the regulations after the 2008 crisis, where they tightened up the requirements on liquidity on the banks. And the result was not only did the banks not want to lend out that money, but they were also constricted by new regulations related to liquidity. And so as a result, basically, this broke down. Now, let me just explain one last thing, because I want to talk about deposit rates. When there's a financial crisis, the first thing the banks do is reduce their deposit rates as close to zero as they can possibly get them. And they do that because they can. And basically, you got no other place to put your money. And the objective of the banks is to keep their margin, because they know in a crisis, their yield on loans is going to fall. And therefore, they've got to try to get their cost of funding down also. Okay, let's look at another question. Himani says, wouldn't lower interest rates lead to hyperinflation in the U.S., ultimately leading to the collapse of the U.S. dollar and ultimately the collapse of fiat currency? Oh my goodness, you've gone so far, Himani. Well, yeah, except there's a couple things that you could argue here. The U.S. has not faced hyperinflation, pretty much ever, but, not in any modern time. We had high inflation during the 80s, due not to government printing, but due to the oil crisis, basically, and the oil embargoes. And oil prices went up massively, and that drove inflation. But it wasn't hyperinflation, right? Hyperinflation is extreme, 50%, 100%. I don't know what the cutoff is for hyperinflation. So is it possible that the U.S. could face higher inflation going forward? Definitely, definitely. But it's been pretty interesting that, the U.S. is a pretty resilient economy, and ends up happening is that higher inflation doesn't go through into the economy as easily. Now, I think you can make some argument that, well, wait a minute, we were in a low inflation environment over the last 40 years. If we go back to this chart, in fact, we can see that. I'm going to just go back to the first chart that I looked at. Let's see, this one. This one shows you that we had a decline in interest rates. So this is long-term government bonds rates peaked at about 14%. And so inflation was a component of that. And what we can see is that those long-term rates fell for basically about from 1980 or so until 2020, let's say. So we're talking a 40-year decline in interest rates. So this is an argument in favor of what you're saying, Himani. So let's look at that argument for a second. Why did interest rates fall so much in the US over those 40 years? Well, number one, they drilled. A lot of oil came out of the earth in Middle East and in the US, and that drove down oil prices. And that was a long-term trend with oil prices coming down. The second thing that happened was innovation. There was a lot of innovation that drove down costs related to internet and the like. And the third thing was we had about 750 million people from China enter the labor force during that 40-year period. And you just can't offset the decline in wages of 750 million people coming into the workforce. And the result of that was that there was constant downward pressure on labor prices. And all of those things combined, along with some other stuff, kept the interest rates coming down, and the end result is that inflation never really went out of control. Now, you can argue in favor of what you're saying. You could argue that, well, we don't have those factors in our favor. In fact, they're just the opposite for China, let's say, where China's getting more expensive as a manufacturing base, and U.S. is putting on tariffs and all of that. All right. Lee says the Fed is also revising the prime bank reserve requirements, allowing more room for expansion. Yeah. So reserve requirements, generally, when we talk about reserve requirements, we can talk about cash reserve requirements, where banks are required to have a certain level of cash on their balance sheets. Okay, let's go back to the presentation, and I'm going to go through some other numbers. So let me advance back to where I was. So here we can see, now what you can see is that I've broken out the developed market into Americas, Europe, and Pacific. And I think it's interesting because what it shows us is that America's is at about 3.7, Europe about 2.3, and then Pacific's at 1.5. So you can get a picture that developed markets in the Pacific region, mainly Japan, is very low rates. Now that's 3-month yield. What about 1-year yield? Yeah, 1 year is about 1.7 in Pacific. And if we look at 10-year yield, yeah, actually it's about 2.6 in the Pacific. So all of a sudden, 10-year yields have risen quite a bit in the Pacifics versus the Americans. And we can see that emerging markets basically have double the developed market yield. And that's where things are at. So for developed markets, 3-month rates are far apart, led by Americas at 3.7, Europe at 2.3, and Pacific at 1.5. And developed market 1-year rates cluster more closely with Americas at 3.5, Europe at 2.3, and Pacific at 1.7. And developed market 10-year rates narrow further, ranging from 4 to 2.6 in the Pacific. So this gives you a picture of what's happening with developed market rates. But that's not all I got today. I'm going to talk about emerging market rates. Now, for any of my friends in Bangkok, I think you'll notice that location. Just type it in the chat. What do you see there? One of the things you're going to see is something's missing on this corner. Can you see what's missing on this corner for those who know Bangkok very well? Okay, let's look at emerging markets. So I'm going to extend this out over to the right. And what we're going to see is emerging Americas. So think about Mexico, Brazil, and the like, is at 11.5, incredibly high. Emerging Asia is at 2.1. That's incredibly low for 3-month money. Europe, emerging Europe is at 18.4. And Middle East and Africa is at 16, and frontier markets are at 16. Now I see that Lee has correctly named the place, the intersection, but he did not correctly identify what is missing in this document or in this picture. There's something obviously missing. So now let's look at 1-year rates. And again, what we're going to see is for 1-year rates, America is still really high at 11. Asia is still really cheap and low at 2.3. Europe still high. Frontiers all the way out at 19.5. Think about frontier. We're talking about, for instance, Vietnam has been identified as a frontier market. Egypt as another example. Finally, let's look at 10-year money, 10-year yields on government bonds. And what we can see, look at the frontier. Frontier is at 29.1. If a frontier market wants to borrow money, a frontier country wants to borrow money, they're going to have to do it at a very, very high rate. And Europe, 14.9. Asia, 2.9. Now, what's the main emerging market in Asia? It's China. And the result of that is that China is, and I'm not presenting the whole presentation today, but China basically having such a low interest rate because of low inflation and the like, is part of why, it's the main reason why Asia is so low at 2.9. And that's one of the reasons why you can also say it's very possible that we don't have runaway inflation in Asia. Roman says, do you feel that emerging markets such as Brazil offer above average rates, both in the short term and long term, or do you think that inflation eats it? Yeah, so this is the whole thing. Right now, in our all-weather strategy, we're overweight Brazil. And so really it's going to come down to, Roman, when you're looking at these emerging markets like Brazil, think of Argentina also and other markets in Latin America in particular. It's a constant battle between inflation, currency value, and stock market. So inflation, currency value, stock market, they're constantly changing. I don't think that emerging markets like Brazil, as an example, in Latin America are going to all of a sudden have a dramatically lower inflation, although it could be. That would be a very good sign. But it's really the interplay of where the market is, where the currency is, and where the expectation on inflation is. And if that balance tips in favor of lower rates, lower inflation, then I think we could see that it could do better and better. So it's really, in those emerging markets, it's really about, following what's happening with those 3 points. Well, we covered a lot of stuff today, and I want to thank you for joining. This is the Valuation Master Class Show. And remember to send me a message at me@andrewstotz.com if you want this presentation. And that means also that you're going to get my global interest rate chart book. This is Andrew Stotz. Thanks for joining. Great questions and comments from you all. And I'll see you in the next Valuation Masterclass Bootcamp.